Okay. We have looked at property, plant and equipment, LK 16. So the last item that was remaining on this was impairment. As I told you, impairment will be looked at subsequently. So let's look at question number 6, which was the question which came in the September 2016 examination. So this is the question. The following information is extracted from the books and records of Saubhagya Bank. Machinery was purchased on 1/1/2012. Machinery was purchased on 1/1/12 at an initial cost of rupees 100,000 and was sold on 30th June 2015. And it has been sold for rupees 70,000. Right. The second point is very important. The depreciation policy of the bank is to charge full depreciation for the year of purchase. So, year of purchase full and no depreciation for the year of sale. For the year of sale, okay. So, no depreciation year of sale, no depreciation. Okay, right. So these are the key elements that we have got to know. And they also say the annual depreciation charge for the machine is rupees 10,000. They are giving you another annual depreciation is rupees 10,000. Right. So let's look at the questions. Answer the following questions based on information given under A to C above. What is the carrying value of the machinery at the time of the disposal? Prepare the ledger account on disposal of machinery, that is the T account. What is the profit or loss on disposal? Then the last part, explain 2 methods of calculating depreciation for property, plant and equipment. So we are clear with the last part where you can write 2 methods of calculating depreciation. We have already learned 5 methods. So out of which you can talk about 2, but the first 3 parts. What is the carrying value? Putting up the disposal of machinery account, and then finally the profit or loss. Right. So now you can see on the board I have put down all the timeline, that is from 1st of January 2012 to 31st December 2015. So the basic idea behind this is that we are assuming that it is a 1st to 31st December company. Okay, so financial year is ending on 31st December every year. So the cost is 100,000 and the disposal is taking place in the year of 2015, and that is on 30th June 2015. In addition to that, they have spoken about the policy of the company, depreciation policy, which is which is full year depreciation. Full depreciation in the year of purchase. So year of purchase is basically this. Year of purchase is this. Then they also say in the year of sale or disposal, there is no depreciation. So they are talking about this particular year in which there shouldn't be any depreciation. That is the company policy. So we have to go by that. Then they have also given you the annual depreciation charge to be 10,000. Now, if this is a normal question, there are few items missing. Say, for example, the useful life is not given. Or in other words, the depreciation rate is not given. There is no mention about the residual value. Okay. So, it's only this information that we have to calculate or compute the required information. So, for us to calculate the depreciation, we have the cost. Assume that the residual value is 0, but the depreciation rate is not there. Now, by multiplying the cost minus residual value and the depreciation rate, what do we get? When you multiply the cost minus residual value by the depreciation rate, what do we get? That is the annual depreciation. So, in order for that only, this annual depreciation is given. But what happened in that particular year, some of the candidates, since there was no depreciation rate or useful life given, they didn't do the question. That is, they totally forgot that the annual depreciation is given. Okay. Otherwise, this would have been a very, very simple question to score 20 marks. No doubt you can score 20 marks subject to the last part of the question where you need to write properly on the 2 depreciation method. Okay. Otherwise, this would have been a very simple question to score 20 marks. Right. So going back to the question, first part is to calculate the carrying value. So what is carrying value? Cost minus accumulated depreciation. Now, accumulated depreciation should be from 1/1/2012 to 30th June 2015. 30th June 2015. Now, if there was no policy given, then we would have simply used the prorate convention. That is what we normally use. If the company is silent about its depreciation policy, then we will make use of the standard prorate convention. But here they have given the policy. So which means in the year of purchase, it is a full depreciation. That is 12 months depreciation. Even without that, it would have been the full year depreciation because you have purchased on 1/1/12, which means you will use it for 12 months. Then in the year of sale, they say there is no depreciation, which means even though the company has used it for 6 months in this period, we are not going to consider any depreciation for this asset. Okay. If it was the prorate convention, then you would have calculated a 6 months depreciation here. But this question is very specific, where they say no depreciation should be provided in the year of sale or disposal. So as a result, we are required to calculate depreciation only for the years up to 31/12/2014. So which means basically it is 1, 2, 3. That is D1, D2 and D3. Only 3 financial years will be involved for the accumulated depreciation. Therefore, Answering the first part, first you have to calculate the accumulated depreciation. Accumulated depreciation, that would be 3 years into 10,000, which is rupees 30,000. Okay. Based on that, we can calculate the carrying value. Carrying value as at 30th June 2015, which is equal to cost minus accumulated depreciation, which will give you 70,000. Okay. So this involves two steps. One is to calculate the accumulated depreciation first, and then the carrying value. Quickly take down. Okay. So the second part, where the machine has been sold for 70,000 and you are required to draw up the disposal of fixed asset account. Disposal of fixed asset account. Right. So as you know, we have to draw up the T account. What are the things that you need to include? Okay. So this is disposal of machinery account, and here you will have the date, particulars, and the amount. Okay, so this is the debit. Then on the right side you will have the credits, again date, particulars, and then the amount. Okay, so as you know, the disposal happens in 3 steps. 3 steps. Number 1, altogether it will be 4, but the important items are 3 steps. That is, removal of the cost of the asset removal of accumulated depreciation, accounting for sales proceeds, and the final step is to determine the profit or loss. To determine the profit or loss. Okay. So this three-step procedure of accounting for disposal. First is to remove the cost of the asset. So you know the cost of the asset is 100,000. So what you do? You will credit the machinery account and bring it to the disposal account. And the amount will be 100,000. Okay. Then we have to transfer or remove the cost of, the accumulated depreciation of the asset. Now that is part 1, what you have calculated. As at 30th June 2015, this asset had certain amount of accumulated depreciation. That is what you have calculated in part 1 of this question. So part 1, based on part 1, 30th June 15, accumulated depreciation machinery. You will put 30,000. That is step 2. Step 1 is removing the cost. Step 2 is removing the accumulated depreciation of the asset as at the date of the disposal. Okay. Then the third part, bringing in the sales proceeds for how much you have sold it. So in the question itself, they say it was sold for 70,000. So the next item, 30th June on 15, cash account. Because you have debited cash and credited. That's all. So basically we are done with the 3 steps. Okay, because they wanted also to draw up the disposal account. But the next part of the question is to calculate the profit or loss. To calculate the profit or loss. So in order to calculate the profit or loss, what should we do? We need to do a balancing. So do a balancing of this account. Left side 100,000, right side 100,000. So your maximum total is 100,000. But if you look at it, this side is also already 100,000. That side is also already 100,000. So there is no requirement for us to bring in a balancing figure either to the debit side or to the credit side. There is no requirement because the cost is equal to the accumulated depreciation and the proceeds that you have got. Okay, which means there is no profit or no loss to the company because they have sold the asset exactly at the amount of the carrying value. Okay, they have sold the asset actually at the carrying value. What was the carrying value? That is part 1, what you have calculated, which is 70,000. So since you have sold it for 70,000, there is no profit, no loss. Okay, so this is the second part. Then we have to do the third part where we have to write and show that there is no profit or no loss. So can you take down this? Okay. So now we'll look at the last part. Part 3 is to calculate the profit stroke loss on disposal. So how do you calculate it? It should be sale proceeds minus carrying value or net book value. So sales proceeds is 70,000 minus your carrying value is also 70,000 what you have calculated. So which means your profit or disposal is actually 0. So we don't say 0, it will be nil. Okay, no loss, no profit. No loss, no profit. Okay. So this is how questions might come on LKS 16, that is your PP, but I don't say that it will be this much easy. This is one of situation where it has come very easy. But there were a few other questions in past papers which we will do towards latter part of the module. But you can give it a try by having the papers. There had been another question which is on, I think, that was on one of the multiple choice questions. There were questions, several questions on multiple choice. So questions can come in any type. Like this is one essay type question, but you can also have multiple choice questions also. But the methodology has to be followed. That is how you have to answer the question. Okay. So, do you have any questions or anything to clarify before we move on to the next topic? All is clear. Okay, because now we are almost at the end of August, so we are required to complete all theory part prior to end of September. So we need to do a little bit of rush work. So therefore, I need to proceed to the next topic. So hope you all are clear with what we learned. Right. So let's get on with the next topic, which is already shared with you all. that is on investment properties. Investment property. Okay. Right. So investment property is actually LKS 40. That is the name of the standard. LKS 40, Sri Lanka Accounting Standard LKS 40, which is on investment property. So what do you mean by investment property? That is what we are trying to understand. So when you look at the land and buildings of a company, the land and buildings of a company may be for different purposes. Okay. It could be either for the use of used to run the business, or maybe for some other purpose. What is the purpose? We will look at it now. But basically, if you look at it, mostly the banks do have their own buildings. That is for the purpose of having their branch or having their head office or any other purpose. Like say, you can have your holiday bungalows for the staff, or you can have your training center for your staffs, any purpose. So all those purposes are considered as part of your business. As part of your business. Now, what we are going to look at here is where a property is being held for some other purpose. Okay, that is what is going to be considered as the investment property. Investment property. Okay, so let's look at it. The flow chart. If you look at the flow chart, the property, that is land or a building, or part of a building, or both. It could be anything. You can consider a plot of land, a building that has been built on a land, or it could be both. Okay, right. So if the land or building or both is an investment property, okay, if the considered property, that is land or building or part of building or both, is an investment property, then that is yes. If it's an investment property, how can you call it as an investment property? Is because I am holding it for rentals, that is held for rentals, or capital appreciation. Capital appreciation. These are the two important terms when you talk about investment properties. If it is not an investment property, that is no, then why it is not an investment property? Because you are using in the production or supply of goods or services or for administrative purposes. That is what we learned under LKS 16. Why do we call it as land and buildings? Is because we are going to use it in the production or supply of goods or services or for administrative purposes. But there is another situation also where it is called held for sale in the ordinary course of business. So if you have the handout with you all, just underline the word held for sale. Now this is something different, where you are having land or building or both, but your intention is to sell them. Now who does this? Normally this is done by the property sellers. What do? They take a large piece of land and they divide it into small plots of land and they sell it. So even though they own this particular plot of land, what does it mean? It is not for the purpose of the business, but it is held for the purpose of sale. Because their intention is to sell this larger piece of land or a building to outside parties. So when you can call it an investment property is when you are holding it to earn rentals or you are holding it for capital appreciation. In all other instances, it will not be an investment property. Now let's look at an example. Land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business, right? Now what do you mean by this? A building owned by the reporting entity or held by the entities under a finance lease and leased out under an operating. Okay. Now, if you look at these two scenarios, these are examples. Why do we say example? Is say for example, you are having a building. Okay. You have a house. You have a house. This house is not occupied by you. This house is not occupied by you. So then what can you do? If you are not going to occupy that particular house, then there are two options available to you. Number one, you can rent it out to somebody. Say at a rental of 100,000 per month, you want to rent it out. So what happens here? You are going to earn a rental income out of this building rather than you occupying the building. So which means you are not running a business there, you are not living there, but you are earning and deriving an income out of it. Then it has to be called as an investment property. Okay, that is one type of example. Then the second type of example is where you have a land, a bare land, let's say which is about 2 acres, you have purchased, but you are not doing anything with it. You are just keeping it away. But your intention is that you know the prices of this land is going to go up very soon. Assuming that there is a highway coming up, lot of new building constructions are going to come up. Now you are holding this land not to run your business, but your intention is that this land is going to go up in value. When it is going to go up in value, it is in the long term, not in the short run. Because what happens, if it is in the short run, then you will sell it. But here we are talking about holding a land for long-term capital appreciation. So the term capital appreciation means you are holding this particular piece of land for the purpose of increase in value. If I am to give you in numbers, let's say you have purchased a land for 5 million. Okay, you have purchased a land for 5 million. Let's say you have purchased it now. Now in 10 years time from now, within another 10 years time, you know that there are a lot of constructions happening around and there is a highway going to come up. So you know that this land, price of this particular land will go up largely. Okay. And now we see that after 10 years, now let's assume that you have come up after 10 years after purchasing this land. Now in the land value, if you checked, let's say it is about 20 million, then from 5 million, it has come up to 20 million. That is called capital appreciation. Capital appreciation. So our intention is to see that the value of this particular land going up. If my intention is that, then it is called an investment property. An investment property. So the two examples are where you hold this property, either it could be a land or a building, for capital appreciation. Then the second one is a building owned by the reporting entity, that is the company, and given out to a third party on rental. That is, we call it as a lease. So you give it to a third party for rental. So that person has to pay you a rental on a monthly basis for the next 5 years or 10 years. Okay. When you give it out on that kind of a lease arrangement, then that is also considered to be a investment property. So let's look at this example. A company owns a piece of land. The directors have not yet decided whether to build to a factory on it or for use in its business, or to keep it and sell it when its value has risen. Okay, so this has 3 parts. A company owns a piece of land. Now the question is, we want to determine whether this piece of land is an investment property or not. In order to decide whether this is an investment property or not, they are giving some information. What are the information? The directors of the company have not yet decided whether to build a factory there. So they have not decided yet to put up a factory there. Or, right? So why they are trying to put up a factory there? To use it in the business. Okay? Or to keep it and sell it when its value has risen. Which means they are trying to keep it for a longer period and sell it when the value has gone up. Okay. Now the question is whether this is an investment property or not. What do you think? This is a investment property. Why? According to LKS 40, if an entity has not determined that it will use the land either as owner-occupied property or for short-term sale in the ordinary course of business, the land is considered as being held for capital appreciation. Okay, what I have given here is a theoretical definition-based answer, but you can simply say, based on the information given, the company's directors have not yet decided to put up a factory for the business purpose. Okay, so which means they are not going to put up, use this land for business purposes. That is fine. Secondly, whether they have a target to sell it immediately. No, that is also not there, because they say, or to keep it and sell it when its value has risen. So which means they are going to hold this building for a longer period, or the piece of land. So if they are going to hold it for a longer period means, what is it for? That is for capital appreciation. That term has to be mentioned. The term capital appreciation is very important. So you have to mention that in your answer. So according to LKS 40, when a piece of land is held for capital appreciation, then it is an investment property. It is an investment property. So there could be questions in the examination of this kind, where they will give you some details and you have to determine and justify whether this is an investment property or not. How do you justify that? Based on the theory that you learn under LKS 40. So based on LKS 40, a property can be defined as investment property only if it is not used for the business purposes or it is not sold in the immediate period, which means it has to be either held for capital appreciation or held for deriving rental income. Those are the 2 things that you have to write in your answer. And as we did in LKS 16, we have to look at the exceptions. When and where this standard will not apply. Okay. So property intended for sale in the ordinary course of business is considered as LKS 2. That is, Now these land sellers, property builders, they are not doing this investment property thing. Now, so today, if you look at a condominium building, where you will get about say 50-60 houses. Now, those cannot be called as investment property because their intention is to sell those 60 units. So that is covered under LKS 2, which is called as inventories. Then there is another exception, which is the property being constructed or developed on behalf of third parties. Say, for example, you are a contractor constructing a property for somebody else's requirement. And that is also not considered as investment property because that is covered under the separate standard, which is LKS 11 as construction contracts. Okay. Then, of course, you know, owner-occupied property, that is LKS 16. That is what we learned. Then property under finance lease, which is covered under LKS 17. If it is a lease arrangement, again, you are not supposed to consider it as an investment property. And lastly, the biological assets. That is the tea plants that we were talking about in the tea estates or mineral reservoirs. All those are covered under LKS 41, which is biological assets. Okay. So these are the exceptions to LKS 40. So basically, I am not going to go in detail again because the definitions we have already learned under property, plant and equipment. The same will apply here also. Okay. Fair value, cost, carrying amount. All three are same. You can go back and refer and what we learned on LKS 16. The same thing applies here also. But here what you have to know, the only exception is what is an owner-occupied property. An owner-occupied property is the property held by the owner for the use in the production or supply of goods or services or for administrative purpose. Okay, that is what the new thing that is coming up in this definition. So please remember, these definitions have to be memorized or you have to keep on writing it down and remember those, because definitions can be asked in your question paper. Sometimes I have seen they want you to write brief description about these items, and that comes in as a part of the essay type questions. So where you have to define or write a brief note on those items. So as a result, wherever we learn as definitions in accounting standards, you have to remember those. So like in LKS 16, the recognition of the cost involved or maybe what you pay, here also it is the same thing. Investment property should be recognized as an asset when two conditions are met. So you know already what are the two conditions. It is probable that the future economic benefits that are associated with the investment property will flow to the entity. And secondly, the cost of the investment property can be measured reliably. So the same thing that we learned under LKS 16. You can go back and look at the definition. It was the same thing, where we have said what can be considered as property, plant and equipment and when it should be recognized when these two are present. Then we go into the initial measurement and subsequent measurement. Initial measurement is an investment property should be measured initially at its cost, including transaction costs. So these are very similar to LKS 16. A property interest held under a lease and classified as an investment property shall be accounted for as if were a finance lease. Okay, that is not relevant here because we are not going to go into finance leases now. So basically what you need to know is investment property is initially considered at cost and then it will be considered at fair value. Fair value, that's what we are going to learn. Subsequent measurement of investment property, where you have two modules. One is the fair value model and the second one is the cost model. Okay, so cost model is where you continue to maintain the asset at its cost, and the second method is where you do a fair valuation. Now here comes a difference. Now under the property, plant and equipment, we call it as revaluation. Can you remember? I told you all once in 3 years you have to do a revaluation. Here it is not called revaluation, but it is called the fair valuation. Okay, there is a slight difference which I will explain now. Okay, so whatever the policy the company chooses, it should be applied to all of its investment property. Now I told you, I gave you an example also, the 5 buildings that we considered for revaluation, where 2 buildings were impacted with the tsunami and the remaining 3 buildings were not, so which had a higher value, but the 2 buildings impacted by tsunami had a lower value. So as a result, you can't decide only to revalue the 3 buildings. No. Here also, depending on where you have the investment property, you can't decide to revalue them differently. If you have decided to apply the fair value model, then it has to apply for all the investment properties. You can't exclude any of those properties. Then, when you are talking about investment properties, you have to give certain additional information. What are those? The choice of the fair value model or cost model. So when you are doing the subsequent measurement, you have to decide whether you are going to use the cost model or the fair value model. Whether property interest held as operating leases are included in investment property. So this you have to give what are the detailed interests that the property has when it is classified as a operating lease. Criteria for classification as investment property. Now this has to be given, that is, now we learn 2 things, either to derive rentals or for capital appreciation. Now you have to specify. Say for example, as a company, if you have an investment property, you have to specify why you have classified it as a investment property. Whether is it to derive rental income or because of capital appreciation. Your intention has to be mentioned. Assumptions in determining fair value. Use of independent professional valuers. If you have used professional valuers to do it, then you have to give their details. So you can go through these information when you look at companies' annual reports, specifically banks. When they do the revaluation of their buildings, they give all the particulars. Who have done the revaluation, what is his qualification, everything is given. Then, if you are having it as an investment property, because of the rental income, then you have to specify how much of rental income that you have derived. And finally, like the PPE earlier, if there are any restrictions or obligations, okay, say you can have it as an investment property only for 3 years. Thereafter, government has said, no, you can't have it there. You have to demolish this particular building. Then that is a restriction. So an entity that adopts the fair value model also disclose an reconciliation of carrying amount of the investment property at the beginning and end. So you have to say what was your opening balance and what is your closing balance. And you have to give a detailed description of what happened in between. Okay, that is all about investment property. So this is not a big topic, but I'm just doing it for the sake of completeness, because you need to know what is an investment property is. So out of this investment property, there is one element that you need to consider, which we are going to look at now. So as you know, let's say you have a property. Okay, let's say this is a building or a land. Now there could be only two options. If it is under LKS 16, it is a PP. If it is under LKS 40, it's an IP. IP means investment property, yeah? Short form. Now, if you choose not the cost model, but the fair valuation model or revaluation model. So you choose revaluation model. Here you use the fair value. Okay. We are talking about subsequent measurement. Please follow this. This is very important, right? So for subsequent measurement, under LK 16, you decide to use the revaluation model, and here you use the fair value model. Okay. Now, when you use the revaluation model, the resulting revaluation gain stroke loss. So you know, when you do a revaluation, there will be a gain or loss, which we did the example, the 5 buildings. 3 buildings, the value went up, and 2 buildings, the value came down. So there was a resulting revaluation gain or loss. Similarly here, you do the fair value. So you have a fair value gain stroke loss. Okay. Now, here if you use the revaluation model, the frequency it is optional. But at least once in 3 years. Okay. Here the frequency is every year. If you classify a property as investment property, and if your subsequent model is to calculate it at fair value model, then you have to do the fair valuation every year. You can't do it once in 3 years or as and when you want. You have to do it every year. So what happens? The revaluation gain or loss, or the fair value gain or loss, where will it go? Recognized in revaluation reserve in equity. Okay, this I told you. The revaluation gain or loss goes into the revaluation reserve in equity. But this is recognized in the profit or loss account. So this is one of the key differences, because there had been exam questions. This is one of the key difference between the two. That is, when you have a property which is classified under LKS 16 and it is using revaluation model, means any revaluation gain or loss is recognized in revaluation reserve and under equity. But whereas if it is LKS 40 and if it is using the fair value model, then the resulting fair value gain or loss should be recognized in the profit of. You will see there are questions. The number one question, first question which comes to prepare the financial statements, these two have come. So you have to be very careful. Under LKS 16, you take it to the revaluation reserve. Under LKS 40, you take it to the P&L. In the P&L, you have to show it as a gain. And this is done every year, whereas this is not done every year. Okay, so I would like you to take down this, because this is not there in the handout. So I just wanted to explain it to you all and then show it. So please take down this. It will be very important. So if you have any questions, you can ask. Okay. So now we are going to look at a new topic, which is very important. So chapter 12, which is known as LKS 1, presentation of financial statements. So this is of course a theoretical section where just to give you a basic knowledge, about the financial statements, and also to give you a brief idea about right. So I just wanted to check whether you all have got the handouts. Okay, right. Sorry. So in this particular area, I have put down the presentation as well as two other documents. So we will be going through all three. This particular standard is to cover how the financial statements will look like. Okay. So LKS1 is the standard which talks about the presentation of financial statements. The presentation of financial statements. Okay. Right. So the main objective of LKS1 is that the LKS1 prescribes the basis for presentation of general purpose financial statements. So general purpose financial statement is where those who doesn't have access to financial statements will look at financial statements which are publicly available. So these general purpose financial statements should be detailed enough to explain how the company is actually doing. So that is why we talk about where these financial statements should ensure comparability both with the entity's own financial statements of previous periods and with the financial statements of other entities. Okay. So LKS1, the objective is where it looks at the reader who is accessing the publicly available document, which is the general purpose financial statement, for them to read and understand this easily. And also to compare it with the financial statements of the company in the prior financial year, as well as with any other company. Now, under accounting concepts, we learn something called comparability. So that is what we are talking about here. LKS1 wanted people or the reader to compare financial statements with the company itself as well as with other entities. It also sets out the overall requirement for the presentation of financial statements, which talks about their structure and the minimum requirements. What and what should appear, which we will go through shortly or maybe next week, because this is a bit of a large area. So we need to cover it with the two additional attachments that are given here is to show how companies present their financial statements. So basically that is based on LKS1. Okay. And the message to you all is the question number 1 in your exam paper is also based on LKS1. Okay. So what we are learning here is actually the take home point for you all for the preparation of financial statements in the question number 1. Okay. Definition. General purpose financial statements. Financial statements, those intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to them. So the same thing that I mentioned to you. Every user can't have financial statements as of their requirement. So what happens? The companies, as a result, they publish the financial statements in the public domain for people to access and read if they want. Those kind of financial statements are known as general purpose financial statement. Okay. Then the purpose of financial statement is to provide information about the financial position, performance, and cash flows of an entity. So why do we provide financial statement? Is there is a purpose. What is the purpose? To let them know what is the financial position of the company. Okay. So what do you mean by financial position? How much of assets they have, how much of liabilities that they have, what is their equity position. So you are talking about the financial position of the company. Then secondly, the performance. Now when we do and go and say a company has done well, they have performed very well. When do we say that? When the company makes good profits. So performance means actually the profitability of the company, how well they have done in terms of profitability. And finally, the financial statement should also look at the cash flows. Cash flows is how much of money has come in and how much of money has gone out, and how these money has come into the business and how it has gone out for what purpose. This we call it as cash inflow and cash outflow. So basically, we are talking about three important financial statements. Financial position is your balance sheet. Performance is your profit or loss statement. And cash flow is the separate topic which we need to learn, LKS 7, which is on statement of cash flows. So in exams, actually, the financial position and performance related to statements are tested under question number 1. The cash flow question comes separately as a separate essay type question. And there had been instances where all three statements have been tested in exams. And also, like under the question number 1, you also have another statement which is called statement of changes in equity, which we will learn shortly. Then the financial statements also looks at whether the management stewardship of the resources of the entity are reflected. What do you mean by management stewardship? Is how the company is managed by your top management, that is your corporate management, or by your board of directors, how they are making decisions, whether their decisions are reflected in these financial statements. Okay, so there is another topic which will be coming under your module is to look at the regulations to banks. Under that, there is one topic called corporate governance. This corporate governance is what is meant by management stewardship. Management stewardship means how the companies are managed by the directors or the corporate management of your respective organizations. So what should be provided in the financial statements? These are the things. As I told you, every reader should be able to find out what are the total assets, what are the elements there, what are the total liabilities, what are the elements there, what are the equity components, how much of income and expense this company has generated, contributions by and distributions to owners in the capacity as owners means how much of dividend or other form of income that you have given to your shareholders. And finally, what are the cash inflows and what are the cash outflows of a company. So your financial statements should reflect all these components that are listed here. Okay, basically we are looking at that. How much of assets, how much of liabilities, what are the equity components, what are the income and expense sources, how much of dividend you have distributed to your shareholders, what are the cash inflows and cash outflows. So out of these, if you look at it, number 1, 2, 3, the first 3 items and the 5th item is actually your balance sheet. Or in other words, you can call the 1, 2, 3 is your balance sheet. Number 4, income and expenses is your profit or loss. Number 5 is your changes in equity, statement of changes in equity. And number 6 is the statement of cash flows. So based on this understanding, here comes the complete set of financial statements. What are the financial statements that are coming under LKS 1? A statement of financial position as at the end of the reporting period. The statement of financial position means you can take down, that is your balance sheet. Okay, so under LKS 1, the name given for the balance sheet is a statement of financial position. Then we talk about the traditional P&L, which talks about the profit or loss. That is known as statement of profit or loss and other comprehensive income. That is the new terminology used under LKS 1. Okay. Then number 3, a statement of changes in equity. Again, that is the third part. Now, 1, 2, and 3, the first 3 bullet points is your exam question number 1. Your exam question number 1 covers a statement of financial position, a statement of profit or loss and other comprehensive income, and a statement of changes in equity. Okay. Number 4, a statement of cash flows for the reporting period. That is a separate question as far as you are concerned, and that is LKS 7. We will learn it later. Statement of cash flows is LKS 7. Then the last part, notes comprising a summary of significant accounting policies and other explanatory. So we said when you are preparing financial statements, you need to have accounting policies, which talks about your concepts, assumptions, estimates, everything has to be covered there. And also any detailed information to support your financial statements. Now, earlier under LKS 40 also we learned that certain disclosures are these additional information that you need to provide. So in addition to the financial statements, if you look at a company's annual report, they talk about several other information. This we call it as a financial review by the management. That is, your corporate management or the directors, how do they see the company's performance? They talk in terms of, this is like a text explanation of your performance. Now, in all the statements, financial statements that we saw, we talk about numbers. You give everything in numbers, but here we talk in terms of terminology. What has impacted the business? How do we achieve that? How did we manage our risk? What are the sources of funding that we use to run the business? What are our strengths? What are the weaknesses? All those are discussed, which is called the financial review by the management. Okay, so here only they talk about the factors or influences determining your performance. So how did your profit go up? What were the reasons? Whether the company's the country's inflation had an impact on you, or maybe the unemployment had an impact on you. The economic factors, how did they impact the business of the company? Now, say for example, in the current context, the COVID-19 pandemic is having a greater impact on the organization, especially on the banks. Now, when you look at the financial statements or the annual reports, which are to be published in the next year based on 2020, we'll talk a lot about this COVID-19 pandemic, because currently the organizations are going through a tough time, which has impacted the economy as well, or the global economy. And also, this might continue even for 2021 and 22. We don't know. So the impact of this current pandemic is going to continue. So companies have to talk about it. Then only the reader will understand how these have impacted the business of the company. What has impacted their profitability? Why their financial position has come down? All those have to be given in detail. So whenever you are preparing financial statement, as I told you, you have to comply with the accounting standards. So here we have two sets of accounting standards. One we call it as SLFRS and the other one is LKAS. Okay. So before moving further, I just want to explain you what are these two. Okay. So have a look at the board. So the financial reporting of companies in Sri Lanka are based on these two sets of accounting standards. So this is what we learn. LKS 16, LKS 1, now we are learning LKS 1, then you have LKS 40, likewise there are a few more standards to come. Similarly, there are SLFRSs also, which we will learn. One of the important accounting standards, that is SLFRS 9, which we are about to learn. So the financial statements are prepared based on these two accounting standards. So who does this? This is by CA Sri Lanka. They are the ones who govern this, the accounting standards that are to be used in Sri Lanka. So the Chartered Institute of Sri Lanka is the authority who drafts these accounting standards for us to be used in preparing financial statements. So what do you mean by LKAS is, this we call it as, LK stands for the country code and this is the accounting standards. Okay, so Sri Lanka accounting standards, right? Then we also have SLFRS. This goes as Sri Lanka Financial Reporting Standards. Okay, Sri Lanka Financial Reporting Standard. Now, the importance is these LKASs are based on the IAS, that is international accounting standards. Now, there are a global accounting body, which is International Accounting Standards Board. They draft these financial standards to be adopted by the companies. So, the global standard is International Accounting Standard, which goes as IAS. That is what we have used in suiting to the current Sri Lankan context as LKAS. Then SLFRS means similar to the IAS, we have something called IFRS. That is International Financial Reporting Standards. So that is what has been converted into SLFRS to suit the requirements of our country with the context of our economy. So every country is like that. They use these IASs and IFRSs to suit their own countries. They have taken the accounting standards. Okay, so this is what we learn. LKS 16, LKS 40, LKS 1 now. We will learn SLFRS 9. So there are various types of standards like that. So please take down this. Okay. So basically, what this talks about is your financial statements that you prepare should comply with the SLFRSs and the LKSs that are defined by the CA Sri Lanka. Okay, so the following points made by LKS1 actually talks about this. That is, you have to comply with all the SLFRS and LKSs. All relevant should be followed if compliance with this is disclosed. You have to use appropriate accounting treatment. If you are not in a position to rectify any errors. So basically what they are talking about is, if you are following these standards, you have to disclose it. You have to say that our financial statements are in compliance with SLFRSs and LKASs. And if you have stated that, it is very important that you need to follow them and you have to disclose that you are in compliance with them. So the first step is you have to select and apply the accounting policies. Now the accounting policies of the company are basically built around the SLFRSs and LKASs. Step 2, presentation of information in a manner which provides relevant, reliable, comparable and understandable info. So you know these principles: relevant, reliable and comparable, which we learned maybe in the second chapter of our module. Then wherever necessary, you have to provide additional disclosures. Okay. So LKS 1 does not allow assets and liabilities to be offset against each other unless such a treatment is required or permitted by another SLFRS or LKS. Now say for example, I take an example. Because we are coming from a background of banks, so we'll take the banking example. Let's assume there is a customer who has deposited money with the bank say 5 million. So how this will appear in your financial statements? The customer has given you 5 million in cash. So your cash will go up by 5 million. And this 5 million is reflected as a liability, which is deposits in your balance sheet. So asset is cash, liability is deposits. Okay. Now the same customer comes to you and asks for a loan. Let's say a 3 million loan. So when you give a 3 million loan, what happens? Cash will go out 3 million and you will create a new asset called loans. Okay. So let me explain this in the board so that you will understand better. Now, for assets, liabilities, and equity. Okay, just take A. So initially what happens? Let's say stage 1. A customer comes and gives you money, 5 million. So you have cash, 5 million, and you show deposits. Simple as that. Then stage 2, the same customer comes to you and asks for a loan. Let's say a loan of 3 million. So you create a loan, which is also your asset of 3 million, and you deduct 3 million cash. Okay. So now look at your balance sheet. How will it look like? 5 million minus 3 million is 2 million. Loan is 3 million. And deposits. So again, your assets and liabilities agree. Now, what do we try to understand by the term offsetting is this. The deposit and the loan that you have in your balance sheet is from the same customer. Let's say is customer A and this is also customer A. What does it mean? This customer A is supposed to give to the bank 3 million because he has taken a loan. On the other side, I say that the customer is having a deposit with me, so the bank is supposed to give him 5 million. What does it mean? Customer has to give me 3 million, I have to give it to the customer 5 million. So, can't I do something like this? I'm looking at an option. 2 million cash, no loans, 2 million of deposit. Okay, 2 million cash, no loans, 2 million of deposit. What have I done? I have taken this loan here and I have offset. So I have removed the 3 million. So now I have only need to give 2 million. Okay, that is called offsetting. You take one of your assets, set it off against the liability, or you take some liability and set it off against the asset. But we have to be mindful, it has to be to the same party. It has to be the same party. You can't do it for different parties. Customer A and customer B, no, you can't do. If it is customer A, yes. But as per LKS 1, they say you can't do this. You can't do this. Okay, that is what we are trying to understand. offsetting is not permitted as per LKS1. This you can't do. You have to keep it as it is. You have to give 5 million as deposits. You have to receive or recover 3 million as a loan from the customer. That is what LKS1 is trying to explain. LKS1 says you can't do this offsetting business when you are preparing your financial statements. Okay? Now with that idea, look at this. What does it say? LKS1 does not allow assets and liabilities to be offset against each other unless such a treatment is required or permitted by another SLFRS. So LKS1 does not permit you to do it unless some other accounting standard allows you to do it. Okay, the same example that I showed you. There may be instances where income and expenses can be set off. Okay. There are certain SLFRS and LKSs permits you to do it. Certain gains and losses or related expenses also can be set off. Say for example, sometimes let's look at disposal of fixed assets. So when you look at disposal of fixed assets, let's say you have 5 types of assets. Out of these 5 types of assets, in 3 assets you get a profit. In 2 assets you get a loss. So what do? You can set off the profit and loss together. There is no restriction for that. That kind of an offsetting is permitted, but not the example that I showed you on the board. Okay, so that is what it says. Income and expenses can be offset with one another, but not the related assets, liabilities, or any other. Okay. Comparative information. LKS1 requires comparative information to be disclosed for the previous period for all numerical information unless another LKS permits requires otherwise. Okay, so I think we spoke about comparative information when we did the initial introduction for accounting. So you know you have to give the current financial year and the new financial year. Sorry, previous financial year. Comparatives should also be given in narrative information where helpful. So if somebody is trying difficult to understand what has been given there, you have to give it in narrative form also. Comparatives should be reclassified when the presentation or classification of items in the financial statement is amended. So if you do reclassifications of your items in the balance sheet or the P&L, accordingly, the comparatives also should be done. Okay, right. So what do I do here is I just want to show you the financial statement Yes. So look at this. This is, of course, I have extracted it from the annual report of Commercial Bank for the year 2019. Now, when you look at this financial statement, this is actually the name given for the P&L. I'll come to that later. Now, what we are talking about is this. You see, the financial year, current financial year is 2019, which is shown in black. The numbers are in black. But what you see in the other column, which is 2018, that is your comparative column. Your comparative column. So this is your bank and this is your group. And these are the items that you show in your financial statement the list of items. Even in the balance sheet, that is your statement of financial position. You see the name, statement of financial position. There also where you show the assets, the liabilities, and the equity. You see? So all three elements are given, and this is what is shown in black is your current financial year, that is 2019, and your previous financial year is 2018, which is given in blue, and that is your comparative information. That is your comparative information. So going back to the presentation, you see LKS1 requires comparative information to be disclosed for the previous period for all numerical information. Okay, so whatever the numbers that you saw in black, that is for the 2019, you already saw for the comparative numbers for 2018. Okay. Disclosure of accounting policies. So measurement basis used in preparing the financial statements, each specific accounting policy, everything has to be specified in your financial statements. Now, of course, I have not given the notes or the disclosures in the financial statements, but because that is too lengthy, so you can go through easily in the financial statements that the notes and accounting policies are also given. Say, for example, if you look at what I showed you now, in this, you will observe there is one column which says note, you see. So in the financial statement, there are note numbers given. Now, say for example, in your exam, when you are doing workings, your workings have to be referred to your answer. So what happens in financial statements also, when you prepare, you can give notes. And those notes will have numbers, 28, 29, likewise what is shown here. So for each item, there is a note given. And in this scenario, they have given the page number also, like because this is a bulky book. So you have the note number 28 on page 190. Likewise, you have it for all your financial information. Even for your P&L, you can say note number 12, note number 16. Likewise, you will have. By the way, I need to mention that this is the structure that you need to follow for your financial statements of question number 1. Okay, so start looking at these financial statements. What are the elements that have been put there in the financial statement? How it is presented? All those, please start now itself looking at them. Because by the time you go to exam, you need to know this without referring to any document. Okay, often you have to remember. It will be interest income, interest expense, net interest income, fees and commission income. You will see the same thing is replicated in your question papers as well. Okay, which we will do. Right. So with regard to the contents, this slide, I will explain it to you. Now, if you look at this, if you look at this, now this is another way of presenting your financial statement, where you say income statement, that is to your profit or loss, and continue that with the name, you see, statement of profit or loss and other comprehensive income. Okay. So your P&L has two components. One is called the income statement or your profit or loss, and the second part is other comprehensive income. Other comprehensive income. So both the combination is what your entire P&L statement is. Okay, and there had been another company which I have given, which is the financial report of Haley's. Now there you will see they have given the statement of profit or loss, and also they have given the term statement of comprehensive income. Statement of comprehensive income. Now this I want you to understand properly. So let's look at it on the board. So you have a statement called statement of comprehensive income. In short form, we call it as SOCI. SOCI, statement of comprehensive income. Now, the statement of comprehensive income has two components. One is profit or loss. Okay. Then the other part is other comprehensive income. Now, in your exam question number 1 will be this: requesting you to prepare a statement of comprehensive income. Okay, required to prepare a statement of comprehensive income, and along with that, you will have the statement of financial position as well as the statement of changes in equity. But what these companies do when they go and publish financial statements, they use different terminologies, which is also permitted by the accounting standards body. So the other statement of comprehensive income is broken into two parts. One is called the profit or loss, and the other part is the other comprehensive income. So what does the companies do is they give this as a separate statement, as statement 1, and then they give another combination of this and this as 2. Okay. So how do you combine this? Profit or loss and other comprehensive income. Now that is what you will see what commercial bank has done is, you see, statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. Okay. There are certain companies, what do they do? The profit or loss is also known as income statement. Another name, just another name. So what commercial bank has done is that, you see, they have used income statement. So another name for this component of profit or loss is income statement. Then statement of comprehensive income has two components, this and this. Then what the companies do is they combine these two and give the second statement. Now let's go to the Haley's. You will see Haley's what they have done. Their first part is statement of profit or loss. The second part of them is statement of comprehensive income. That is what I told you. So what do? They combine both and give it as one particular statement of comprehensive income. Okay, but for exam purposes, we will not do two separate statements. We will go by one particular statement so that it will be easy for us to understand. Okay. So as far as the structure and content is concerned, that is what it means. You have to understand clearly how this P&L is reported in the financial statements. So the remaining items are all reading material. I just want to highlight a few more things. Looking at the financial statement, I will show that and explain it to you. Now see, if you look at this financial statement, there are a few more other things that you need to understand. Okay. Now here you have the company name. But in exams, when you are preparing, you have to write it in the middle of the statement. Yeah, you will say the company name in the middle. Then you have to specify what is the statement. That is this income statement or whatever. Then you have to specify for which period it is. Now here they say for the year ended December 31st. Now in your exams, you will be asked only for one particular financial statement. But here you see they are giving you the comparative also. That's why they have put for the year ended December 31 here, and there are two columns. So the reader will read it as for the year ended December 31, 2019, and then this column refers to the for the year ended December 2018. That is how the reader will read the financial statement. Okay. Then it is very important for the reader to know in which currency these financial statements have been prepared. That we call it as presentation currency. Presentation currency. Very important. So if you look at the financial statements carefully, you see here they say rupees 1,000 everywhere. Very important. Which means this financial statement is prepared in terms of rupees. In terms of rupees. And also this amount is presented in thousands. In thousands. That is another important part. Which means now nowadays the banks and the companies are having big numbers. So as a result, they can't present their full numbers in the financial statements. What they do is they reduce the presentation amount, though they are showing it in thousands. Now, if it is thousands, can you tell me, let's take this first number, interest income. Okay. And this is the amount which I have highlighted. Can somebody tell me what is this number is? How much it is? Can somebody text and tell me what that number is? Okay. So let's look at the board. Interest income is 129,287,743. So which means this is the amount which is given in rupees thousands. So what is the actual figure? Actual figure is 129,287,743, and there are three more zeros. Three more zeros. Now what is this number is? What is this number? This is 100 and so this is thousands. This is 100,000s. This is thousands. Hundred thousands. This is millions, and this is billions. You see? So basically, the interest income is 129 billion, 287 million, 743,000. That is how you read this. Okay. So what is next after billions? We call it as trillions. We call it as trillions. Okay. So let me show you that also. Now, when you go to the balance sheet of commercial bank, you will see all these. When you look at, please look at the assets. So you have the numbers here again, rupees 1,000, but at the bottom, this number 1408941,366. What is that? You have to add another 3 zeros. When you add the 3 zeros, what will happen? It becomes 1,408,941,366,000. That is how we have to read that number. Okay. So when the companies grow bigger and bigger, the amount or the number that you need to present also will be too much. So then you have to cut down these numbers. You have to show either in rupees thousands or rupees millions or rupees whatever. As we go on, the numbers will be shortened to show the correct full number. Okay. So we'll stop there and we will continue next week. As I told you, we have a very strict timeline, so we need to complete all the theory lessons by end of September. Okay, so as a result, I might have some additional lessons in between, which will be posted to you in the form of videos, so you may have to go through. But please make sure that you do revise all what we have learned so far, because we are little by little getting into the tougher areas that we have in our module. So by that time, you should have revised what we have done so far. Be ready with to face the new topics, okay, which are more challenging. Okay, right. So take care.